This is the Friday, May 4th, 2018 version of the Market Plus segment. Joining us now is Shawn Hackett. Shawn, welcome back to the table.
Glad to be here.
Now, we had some controversy here. You are one of the analysts that has said you see corn hitting $8 here. I think you were quoted in Barron's.
That's correct.
When are you seeing $8 corn? This year?
Not this year. I mean, I wish I could make that forecast. It's always possible if Mother Nature gets involved. But looking at a 3-year outlook, we think that the E10 by 2020 policy by China is very, very similar to what we did here 10 years ago. And the way that they're eating through their corn stocks, we think that they're going to be in the market for buying at least 1 billion, possibly 1.5 billion bushels of corn every year to meet their needs. The other double-edged sword to this whole concept is that they don't have enough capacity to produce all the ethanol they want, so they're going to continue to be a big buyer of U.S. ethanol and Brazilian ethanol. So, for example, who's the biggest buyer of U.S. ethanol? It's Brazil, because they're selling it to China. When we look at the confluence of growing exports of ethanol and the Chinese buying 1 billion, 1.5 billion bushels of corn, throw in more volatile weather that we see coming, it's really not that hard to come with balance sheets that would support an $8 market. So and we know people think it's crazy because it's been such a bearish period, but we really think there's a good shot at it, and we wouldn't be surprised if we're too conservative on that number.
Okay, so producers shouldn't be getting quite excited quite yet.
Not yet.
Okay.
But be optimistic. I guess the point to make is don't oversell your crop. Don't sell too aggressively into the future. We think that you're going to be well rewarded by holding back in future years.
Okay. Shawn, you're a new face on the program, so we wanted to make sure we get a little bit of your background for those watching back home. Tell us a little bit about how you got into trading and your position now.
Well, I have my original degrees in chemistry. I started in stock-based analysis. And then I moved to Florida, and I met John Roach from Roach Ag Marketing that many people know. He's a fantastic analyst for a long time, and I worked with him for 5 years. And then, being entrepreneurial as I always am, started my own company 11 years ago, Hackett Financial Advisors, and have been analyzing markets the way we do it with smart money and cash differentials, and have developed a very, very good track record of being a very good predictor of markets for a long period of time, and here we are today. So.
Absolutely, and you follow some different commodities than what maybe most of the trade follows in ag. Tell us a little bit about some of those commodities that you follow.
Yeah, we're a big follower of soft ag, coffee, cocoa, orange juice, sugar, markets that are grown in mainly other countries and aren't grown directly here. So we cover a lot of those markets, and they're very important. We take great pride in being able to help the international farmer like we do the domestic farmer in grains. So it's something that we provide, and it gives an overall robust ag analysis to those that subscribe to our report. So.
Well, we're very excited to have you on the program. Let's also make sure we touch on cotton, because we didn't get to that in the normal part of the segment, and I know you like to talk about cotton. When we look at acreage for this year, we saw an increase. Do you anticipate that to hold true?
We don't. We think they'll get planted, or most of it will get planted, but the problem we have is that the last 3 to 4 years, we've had a very unusual low abandonment rate. Many of the acres in Texas are dryland acres. If you don't get exactly the right rain at the right time, those acres will produce nothing or close to nothing. And so we did a statistical analysis of cotton going back 40 years, and we have never seen a period of 5 years where we've had abandonment rates as low as they were the last 3 to 4. So it's just time for it to happen, and the weather forecast that we see, hot and dry already, and that continuing into June, we could lose 2 million acres off that 13.5. That would mean lower acres harvested from last year, and if yields are down, we could have a smaller crop. The market is not prepared for a smaller crop, and that would necessitate having to ration demand. We think there's a shot at $1 a pound cotton over the next 30 to 60 days if this abandonment rate fear kicks in.
When will that fear kick in?
Well, so we think it actually could be starting right now.
Okay.
Like we just saw the big update today, and the market looks like it's breaking out on the charts. We think it could be starting right now and proliferate right into the next 30 to 60 days. We think there could be a peak. Typically in this kind of a thing, cotton could probably peak in the first part of July historically. So we really like this market, and we think that if you're somebody that has maybe a little bit left to sell, or you're thinking about what you should be doing, we might just hold back a little bit. We think it could be well rewarded for doing so.
Why was there the increase in acreage in the first place?
Cotton's very profitable. I mean, outside of, it's one of the few crops that has actually maintained a profitable level the last several years. So when we were looking at planting intentions in the latter part of February, cotton just stood out as a great market. This was before grains really took off. And everybody decided, let's go plant as many cotton acres as we can, because there's not a lot of crops that we can plant that's profitable. So it made sense. Unfortunately, then we may not get the outcome that we're looking for.
Okay. Before we get to our social media questions, I wanted to touch on soybean oil, because we've had pretty strong export sales here, over the last 4 weeks. We're up 70% over the 4-week average. Where do we go from here? Why do we see these strong soybean oil sales right now?
Well, prices have fallen a lot. And when prices fall a lot, demand tends to pick up. The problem we have with bean oil, it's a derivative market of crushing beans, just like bean meal is. The reason that we're maximizing our bean crush is not because we're not producing enough bean oil. It's because we have a shortage of bean meal in Argentina, and so we're trying to play catch up. So every time you crush a bean and make bean meal, you're making extra bean oil. And so
those are two parallel products.
Correct.
Okay.
So the price has been falling because even though the demand, as you just said, is very strong, we're producing too much oil, and if the price signal we're getting from oil is not going to stop the crusher from crushing, only bean meal coming down markedly would. So although demand is a good indicator for future price, we still think it's too early to expect bean oil to head higher. We're still kind of on the fence of thinking we're in a bearish mode at least into the middle part of the summer. So we're not excited about that market just quite yet.
Okay, something to still continue to watch.
Correct.
All right.
Yep.
Let's take some social media questions. These are my favorite part. From Doug in Iowa, he said, what percentage of corn is produced in the areas that are behind on the planting, late snows, and now rains are slowing progress in the northern corn belt?
I don't know the exact number. I'm speculating from what I know. I'm thinking maybe 20% of the crops behind in those northern regions that are really behind and have really been suffering from the colder, wetter weather, that sort of thing. So we really don't feel planting is going to be a problem in the aggregate. We think we'll gain acres in the areas that are seeing warm weather now, and the planters rolling. We're already hearing seed dealers say
gain acres of a specific commodity, or just gain acres in general.
We think corn acres are going to gain first. We think bean acres are going to gain, and we think spring wheat acres we're going to give back some there. We think that's probably the mix that we're going to see when we get the June planting report. Other than that, though, we really don't see planting being an issue. We think it's going to get planted. We think the numbers are going to be, within the margin of error that we typically see from planting intentions to the actual planting report in June, maybe 1 million acres each way, that sort of thing. So
Phil in Dresden, Ontario asked, specifically at the end of the day, will farmers once again plant more corn than soybeans? There's
a good chance they may. When we're hearing from seed dealers is that farmers have really gotten out there. The weather's gotten to be almost summertime in some places. They're making tremendous progress, and all of a sudden, farmers are going in buying extra bags of beans of corn. So we think it'll be a close call. We'd be willing to bet that the corn market ekes out a victory over soybeans by a little bit of a margin, but not by much.
Okay. Let's take another social media question here as we move along. We have Kendall wants to know, with the very limited new cash crop sales on the books, what is the best way to protect some of that downside risk while leaving upside potential open in both corn and soybeans?
Well, I mean, if you're in a place where you don't know how much crop you're going to have, you're not sure what you're going to plant, or you're just uncomfortable selling a lot right now, I mean, obviously using put options would be a great way to go. We don't like to get fancy with option strategies, selling calls and all this thing. We just like to keep it simple. So I think
farmers can appreciate that.
Yeah, you get these wild things, these butterflies and straddles, and all of a sudden you don't know what you're doing. But we just think straight puts right now would be a logical thing, because if this first half of the summer turns out like we think it is and we get a good weather scare, it'll be worth buying those puts and letting the upside stay open. We think that's not a bad strategy this particular year to do that.
Okay. We have another question from Phil in Dresden, Ontario. He likes to send us a lot of questions on Twitter. What will be the trading range for November soybeans going into July 4th? And then second part of that question, or does this depend totally on the trade interactions between the U.S. and China?
As we said earlier, we really don't feel China is going to be other than a day-to-day volatile kind of thing. We don't think that's going to determine the price of soybeans. We think the price of soybeans are going to be how much acres actually get planted, which we'll find out in June, and what the back half of the weather picture looks like. So when we get into late June and July and we get the weather models that tell us, that'll dictate what that range is. Our view is that the back half of the summer is going to be pretty good weather for soybeans. So we'd be hard pressed to think that we could get a bean market much above 11, maybe 11 and a quarter. Downside, 9 and 3/4, 9.5. I mean, by late summer, I mean, that's really what we think. We're bearish beans. I'm just flat out, we're bearish beans, but we can't be bearish beans if we're bullish winter wheat and corn. That's kind of where we stand.
Are we still seeing meal pull soybean complex up with it? Or is
Meal, I mean, that is the driver.
Okay.
It has been the driver,
Still is.
and it still is the driver. We don't have a shortage of soybeans. There's plenty in Brazil to be bought for the next several months. But when you have the biggest exporter of bean meal in Argentina coming up way short, and we're still not sure how short. We're still trying to figure that out. I mean, there's heavy flooding going on, and the numbers may still be coming down there. So it could be still even shorter. So bean meal is still the driver and still will be the driver so long as bean meal is strong and the crush is strong. Beans are going to be well supported despite what seems to be adequate supplies.
Okay. Another question here. I think it's our last social media question. We have Merrill in Missouri. Wants to know the U.S. dollar index is on the rise. There is an inverse relationship between the U.S. dollar and the CRB index. Do you see any of the grains potentially breaking with that relationship, and why?
Short term, yes. Intermediate term, no. It's a big problem. We have been very bearish the dollar, and our forecast was that we were going to bottom in the spring and that we would go through what we call a bear market rally in the U.S. dollar, which we believe has already begun. We don't think that the rally will impact grains in the first half of the summer. We feel there's been enough tightness in the weather that's already taken place and that is to take place that we can ignore the strong dollar for at least the first half of the summer. But once the weather eases back as we expect and the exports start becoming a little bit spotty because of it, we think that we'll reconnect with that relationship in the back half of the summer. So it is a bearish headwind that we think is going to get more bearish, and it's something we're really concerned about in the back half of the summer into the fall, leading to kind of a healthy, nasty correction in grains.
Okay. Shawn Hackett, thanks so much for being across from me tonight.
It was a pleasure.
Join us again next week when we see how opposing forces have found common ground in fighting for the Mississippi River, and Tom Fitzenmeyer will sit across from me at the Market to Market table. Until then, thanks for watching, listening, or reading. I'm Delaney Howell. Have a great week.